All right, welcome back, traders. John Caruso here for the week of December 5th, another edition of Futures Forecast. I am recording December 4th, Sunday evening. We're going to do a quick look back and review some of the data that we did see come out last week, take a look at market performance, and then, of course, take a look at some of the charts and hopefully get you guys off to a good start for the trading week up ahead. So the S&P 500 did finish up 1% last week. NASDAQ was up 2%, and we did see the Russell 2000 up 1.25%. Gold did finish up 3.25%. Silver up 9.68%. Platinum up 4%. Copper prices were up 6.18%. Oil prices were up 5.61%. And RBOB gasoline was up 1% on the week. So clearly a risk on week in terms of market performance. And of course, we did see the 10-year yields decline by 18 basis points, extending its losing streak to 4 consecutive weeks of yields trading lower. Q3 GDP did come out better than expected, 2.9%. Chicago PMI cratered last week to 37.2. That is a recessionary number. The ISM Manufacturing Index also did break that benchmark 50 level and did move into a contraction at a reading of 49. That is also a recession number as well. We did hear from Jay Powell on Wednesday. Of course, the market did have a very big reaction on Wednesday to Powell's speech. Powell all but confirmed information that we already knew, and that is to expect a 50 basis point increase at the December FOMC meeting on December 14th. So all in all, Powell did strike a less hawkish tone than what we've grown accustomed to over his last several speeches. And so the market took that and rallied on that news. Of course, on Friday, we did see the non-farm payrolls report that came out. Was a hot reading on the surface, up 263,000 jobs versus an expected 200,000 jobs. Wages increased up 0.6% month over month versus 0.5% in the previous reading. So that is certainly not something that the Federal Reserve wants to see. Of course, the Fed is trying to tame inflation. And when you start to see wages increase and start to keep up or try to move up towards the rates of inflation, that's certainly not helping the Fed in terms of their inflation fighting goals. There was something interesting that I read this weekend out of David Rosenberg's research. He had a note out that kind of did a little bit more of a deeper dive in terms of the jobs data that came out on Friday. I'll read it to you guys. While employers expanded payrolls and raised pay more than had been forecasted, they also appeared to compensate by reducing hours to save on labor costs. The average work week declined by 0.3%, which is the equivalent of a 380,000 job loss. So that was something interesting, that dichotomy between rising wages, employers paying higher wages, and also cutting back on the work week. I thought that was a very interesting read. So perhaps the jobs number wasn't as blistering hot as many people took it as. And of course, we did see the market actually sell off aggressively on the release of that number. I believe the S&P traded all the way back to about 40.15 before rallying back and closing the session out at 40.68. So well off the morning lows. And clearly, we've got this upward bias, this risk-on mentality in the market, and it is not dissipating here anytime soon. We do have a lot of seasonal factors right now that come into play that are very bullish for risk assets. That, of course, includes the metals complex, the energy complex, and we're starting to see a lot of that play out on the charts. So let's jump over to the charts right now and take a better look at what's going on. So we're going to take a look at the December S&P 500. I've got a weekly chart up here, so clearly you can see this down trend that we've been in. The trend is bearish. It remains bearish on the S&P 500. That's, of course, on a 3 to 6 month trending basis. However, we do have this upward bias, this upward bullish trade that is developing. We measure trade on a 1 month basis. And of course, we're extending this rally. Let's take a closer look here at the daily. Now you can see our drawing on this chart back on, it looks like November 21st. This market is following this pattern pretty much to a T. Very accurate forecast on the S&P 500. So we did have the S&P 500 back on the 21st kissing off of this trend line. That actually happened a little bit later. That actually happened on Wednesday following Powell's speech. And we saw this big upward surge in the market. We did take out this long-term downtrend line that the market has been respecting for the better part of this year. And we did close above that downtrend line. And of course, the 200-day moving average, and we're still above there Sunday evening. So it's clearly risk on. We did have two potential tracks that we thought the market could take. We did think that we would, at a minimum, get a rally back to the 200-day and this downtrend line, and then perhaps fail. And we also did have the second track, which is the higher track, of course, which could take us all the way back up to the 71.6% Fibonacci retracement. That's measuring from this peak to this low. And you get the 71.6 up here that comes in right around, we're going to say, between 4150 and 4160 on the upside. So perhaps the market is going to try and test up in that level there before we do see perhaps a mini period of risk that sets in about middle of December. That's going to take you that's going to take you into that December CPI reading, which comes out on the 13th, and of course the Fed meeting on the 14th. So perhaps we do have a mini period of risk, come back down, kiss the other side of this downtrend line before we try to reattack higher. Now, ultimately, I remain bearish on U.S. equities. However, I do recognize what's going on in the market right now. And clearly there's this upward bias, this upward momentum that is pushing up on the market. So clearly bullish trade, but we are living inside of a longer term bearish trend. And we still think that there's going to be plenty of risk out into 2023, perhaps in the first quarter. So we're going to keep all of that in mind as we're trading the S&P 500. So it's kind of trying to balance that cognitive dissonance in your head. You can be bullish for a trade, but you got to realize that we are still living inside of a bear market and that recession remains our base case out in 2023. So that is a look at the December S&P 500 futures. So we're going to flip over to the 10-year yields here, TNX. It's the 10-year Treasury note index. Clearly, we've seen some risk off in yields. We've seen some risk on in the bond market. The bond yields, this is 4 consecutive weeks of decline now. This break here of this level here that we have drawn in at 355, that moves this trend to bearish inside of our model. So we are buyers of U.S. Treasuries right now. As a matter of fact, we have been. We started back in back in October. We started taking money to the to open auction. So we've been buyers of bonds since about October, and we're probably going to be more aggressive buyers of 10-year futures and 30-year futures at the long end of the curve going forward if we get the right prices. Now, I am expecting a bounce, a little bit of a correction in here. We have had a pretty nice sizable drop. 10-year yields are down 83 basis points from this peak that we saw back at the end of October at 433. We're down 83 basis points. So that's a pretty hefty drop that we've seen. So I am expecting a bounce here. I do have an oversold signal coming in right now on the chart. We did have that gap and go lower on Friday. And I do expect the market to try to retest up in this level here before perhaps yields come down and retest this 325 area on the chart. So that's kind of how I'm looking at the 10-year Treasury index right now, expecting a bounce. We've got an oversold signal. We are bearish trend. And if we do get that bounce that comes in maybe up around 380 to 385, we are going to look at purchasing long 10-year Treasury notes, and we'll probably put that signal out to our traders under our trading desk here. So that is a look at the 10-year Treasury index. We're going to switch over and take a look at the gold market here. Gold's catching a nice bid here Sunday evening. Another bounce. Now you can take a look at our drawings here on gold. We actually started putting these drawings in back on the 18th. And this market has been following this projected path perfectly, I must say. We did see that big outside day reversal candle that came, I believe it was just 1 or 2 days prior to Thanksgiving. We did put out some buy signals to our traders right around 1740. We have all that information documented. And we have seen nothing but this market push higher ever since. Now, I am getting an overbought reading up here in the gold market. I do believe that the market can stretch as high as 1825 to perhaps 1830. Now, why do I say that? Let's take a look. Of course, we've got the top end of the range now that's expanding to about 1830. And then, of course, we have this peak over here from back in mid-August that we do think the market is going to try to challenge. But we do expect the market to pull back after challenging that 1830, perhaps getting as high as 1840 before another period of risk sets in the gold market. Now, how deep could this next sell-off get in gold really kind of remains to be seen. The reason why we have this chart drawn in this fashion here is we do believe that gold on the weekly chart is trying to form an inverted head and shoulders, which is a massive reversal pattern. If you're into reversal patterns, inverted head and shoulders pattern. So this next period of risk we think could perhaps stretch as deep as maybe 1720. If it takes the lower path, perhaps it can stretch as deep as 1690 before we get a much more favorable period for gold that happens out into 2023. So that's a look at December gold. Very, very bullish here in the over the long term. I do think that the market is rising into overbought territory right now, so you got to be careful. I do think that maybe you can see another $10 to maybe $20 of upside before perhaps another period of risk sets in that could carry the market perhaps as deep as 1720 over the next few weeks. So keep that in mind when you're trading gold. But all in all, gold remains bullish trend. That market should be traded with a bullish bias going forward. All right, we're going to flip over now and take a look at, lastly here, crude oil. Now, we did hear from OPEC over the last few hours, and it looks as if OPEC is going to stay the course, and they're going to maintain their current policy, which is reducing oil production by 2 million barrels per day, or approximately 2% of world demand, and they're going to stick with that policy from this point until the end of 2023. Now, of course, something could change in there. And of course, that is certainly data dependent. And we're going to keep an ear to the ground for future OPEC meetings. But so far, the market likes what it's hearing here. We do have crude oil prices up 1.80% Sunday evening. But clearly, what I'm staring at here on the chart, I'm clearly staring at a bearish trend in crude oil. Of course, we peaked back here back in March. We did re-challenge those highs back in May and June, and then peaked and rolled, and we've been trading bearishly ever since. Now the market did break to as low as 73.50. We did break this key low over here at 76 and a quarter, which was important. But we did, as we have the market drawn in here, we actually do believe that we can see a bounce back towards, I believe this is the let me see, this is the 68.2% retracement level. That's a fib number. I do believe we can rally back into this 83 to 84, perhaps 85 level before perhaps another period of risk or a sell side trade comes into the market and pushes the market back out onto the downside. How deep this market could go on the downside is really anybody's guess. Just from a technical picture, we did mention the possibility of seeing another reach down to this old swing low, which comes in down around 65 in crude. We're going to be watching that going forward. If crude oil decides to continue to grind higher and eventually punches above this 89 area, this 89 area is a big area for us, because if we break through 89, that is going to flip our charts to bullish trend in the crude oil market. So you don't want to be short if we take out 89, but we do believe that there is a sell side opportunity that's going to come into this market around 84, or a rally back to that Fibonacci level right there. So that is a look at the that is a look at the January crude oil contracts. So that's all we have for you here this evening. Hopefully that was helpful. If you would like to, I'm taking requests. So if there's any other charts that you would like me to review, please feel free to send them out. You can email me at jcaruso@rgofutures.com. Please feel free to reach out at any point. I'd be more than happy to assist. Best of luck to everybody out there. We're going to catch you back here next week. Take care.